Elon Musk did not just buy Twitter. He executed one of the most complex, high-stake corporate takeover in the history.
Elon Musk puts in an offer to buy Twitter.
Elon Musk and Twitter announced a $44 billion deal today for Musk.
Says he
This wasn't just about money. This was a battle of legal contract, corporate governance, poison pills, and financing structures, all playing out in real time on Wall Street. If you think buying businesses is just about buying cash, think again. In this breakdown, I will walk you through the legal, financial, and strategic maneuver Musk used to acquire Twitter, and why understanding these strategies would change how you approach business forever. By the end of this video, you will have a hover level understanding of M&A strategy, deal structuring, and hostile takeover. Let's go right into it. Segment number 1, the legal framework of merger and acquisitions. Mergers and acquisition M&A aren't just about money changing hands. They are governed by strict legal frameworks designed to protect shareholders, buyers, and sellers. When Musk moved to buy Twitter, he had to negotiate a complex web of security law, SEC regulations on public companies, fiduciary duty of the board of the directors, contract laws, binding versus non-binding, and also regulatory approval for large deal. Let's break them down.
Assemble.
Number 1, SEC regulation and disclosure law. Because Twitter is a publicly traded company, Elon Musk was required to follow SEC rule on disclosure and reporting. So the key regulation was the Williams Act 1968. The Williams Act governed tenders offer, ensuring that all shareholders are treated fairly when a takeover is proposed. Under SEC rule, anyone acquiring more than 5% of the public company must file a Schedule 13D form within 10 days. This disclosure alert the market and give existing shareholders time to react. So how Elon Musk played the game? He deployed a strategy. He delayed filing his 13D disclosure, which allowed him to continue buying Twitter stock at a way lower price before the market even react. So he initially filed as a passive investor 13G, then switched to an active investor 13D, a legal but controversial move that let him buy at a discount before declaring his real intention. So the lesson here is, if you're acquiring a public company, every move you make is heavily regulated under SEC law. Number 2, fiduciary duties of Twitter board of directors. So the board of directors is legally required to act in the best interest of shareholders. Under Delaware corporate laws, board member must follow 2 key duties. Number 1, duty of cares. They must make informed, well-reasoned decisions. Number 2, duty of loyalty. They cannot act in their own self-interest or block deals for personal reason. So how this affect Elon Musk deals? So Twitter board initially opposed Elon Musk takeover and adopt a poison pill. Well, we'll cover that next. But once Elon Musk offered an all-cash deal at $54.22 per share, the board could no longer argue it wasn't in shareholder best interest. Rejecting the offer essentially would put them in a position or expose them to lawsuit from the shareholder. And the lesson here is, if you make a strong enough offer, corporate board are legally bound to consider it, even if they don't really like you. Number 3, the poison pill defense. Twitter's first move was basically putting up a thing called a poison pill. A poison pill, or shareholders' right plan, is a corporate strategy to make takeover more difficult and expensive. So how it works is, if any investor buy more than 15% of the company, all other shareholders get to buy new share at a discount. So it would dilute the hostile buyer's stake, and this make it exponentially more expensive for this hostile bidder to gain control. So how Musk beat it? Instead of fighting Twitter's board, Elon Musk went directly to a large shareholder and institutional buyers or institutional investor. He offered an all-cash buyout, forcing the board to reconsider. Once the shareholder pressure increased, the board had no choice but to remove the poison pill and accept the negotiation. Brilliant. The lesson here is poison pill can block a weak buyer, but a well-structured offer can always override them. Alright, section number 2, the binding contract that forced Elon Musk to buy Twitter. So the importance of a definitive merger agreement, once Twitter board agreed to sell, they enter into a thing called definitive merger agreement, DMA. The key elements of the contract are the following. Number 1, the specific performance cost. This legally requires Elon Musk to complete the purchase or face lawsuit. Number 2, the $1 billion termination fee. If Elon Musk walked away, he had to pay $1 billion in penalties. Imagine that. Number 2, Elon Musk tried to back out and Twitter sued him. So what happened? Elon Musk tried to terminate the deals, claiming Twitter had too many bots and fake accounts. And Twitter actually sued him in Delaware court, enforcing the specific performance clause. The courts ruled in favor of Twitter, forcing Elon Musk to either complete the acquisition or face severe financial penalties. And the lesson here is, once you sign a binding M&A contract, walking away isn't that easy. The legal consequences can be enormous. Section number 3, the financial engineering behind Elon Musk's buyout. The structure of Elon Musk's $44 billion deals, this is how it works. So Elon Musk didn't buy Twitter with his own money. He used a structured financing model similar to a leverage buyout, LBO. And here's how the funding breakdown. Out of the 44 billion, 13 billion was in debt financing, aka debt, right? Any kind of debt that we have been talking about from banks. There are 33 billion from equity financing, and you know what equity is. We have gone through that as well. Equity basically come from selling Tesla stock or the money from private investor. And hey, in reality, he did not actually sell the Tesla stock. He used that as a collateral, and we'll get into it in our later videos. So Twitter itself took on the debt, meaning Elon Musk actually have put the 13 billion of debt financing on Twitter's, the company that he was about to acquire. Imagine how brilliant it is. He didn't use his own personal financials to buy the company. If he is not buying the company using his own cash, why should you? Alright, number 2, how the debt affect Twitter. Now that Twitter has 13 billion in debt, what does it mean? When a company is loaded in debt, it must generate higher cash flow to cover the debt payment. It must also cut the costs. Therefore, there's layouts reducing office expenses. Number 3, they must increase revenue stream. So there's a thing that comes out right after the acquisition was Twitter Blue, subscription, and whatnot. The lesson here is any large M&A, merger and acquisition deals, don't just change ownership, they change how the business operates. Alright, so Elon Musk's takeover of Twitter wasn't just a business deal. It was actually a masterclass in M&A strategy, corporate law, and high-stake deal making. If you want to invest alongside with me instead, apply at investwithbenjamin.com. Hey, before you go, like, subscribe, and turn on notification so you don't miss the next deep dive. If this provides value to you, let me know. I'll do more. See you in the next videos.